Good morning, everyone. So week 11, cost management. So this is our second last set of material that we'll be talking about before our final test on week 13. This is where we talk about cost management, which is kind of just allocating certain costs to different revenue generating areas. Now, when we say that, that's very similar to what we've talked about with contributory income. When it comes to cost management, now we're looking at it a little bit more when and how to price some of your different revenue jobs. So how to price some of your rooms, or what kind of jobs that you should take and which ones can you say no to. We'll also take a look at in this material is, which I think is really important for us, is if it's worth staying open during that off season. So typically that off season would be the winter season, so January, February, March. A lot of our resorts in the Muskoka area, they close after Christmas, and sometimes right after Thanksgiving. And then also, if you're a ski lodge, as an example, you might close during that summer season or that fall season. So we'll take a look at that. I think it's really important in particular to our group because we find ourselves in that situation often. And this is a case that you can make maybe to your future employers saying, hey, I know at Port Cunnington Lodge that we closed down for the wintertime, but I can make a really good case and we can come up some really good different products to sell during that winter, which will help with all kinds of issues. So we'll go through that and we'll chat about it. So cost management is typically how we look at, again, assigning different costs to different revenue areas. And we've done this before. Direct costs are associated with their own individual revenue generating areas. Food and beverage to the dining room, housekeeping to accommodations. And then indirect costs are split using a bunch of different strategies, which we've already looked at two of the main ones, either as a percentage of revenue or percentage of square footage. Now, we've done this, you understand that part. So let's take a look at a couple different costing scenarios that we need to calculate and then need to make some business decisions if it's worth to take this kind of job. So is it a good idea to sell below the total cost of an item? So if an item costs $100, but we sell it for $80, does that make any sense, or where does that make sense? So right off the hop, most people say, no, that doesn't make sense, because why would you do something like that? You're losing money on it. We also want to look about if it's whether to stay open during slow months or closing months, and I have some other stuff about whether a business is worth buying or not. So what is the minimum price we should charge? So this is kind of some minimum pricing, different questions. So if in this example, a hotel has a fixed cost of $100 per night. So by fixed costs, that means we have all of these costs that we have spread out through the entire year for our business. We know that each hotel room should have a fixed cost wrapped into the sales price of $100. And that could be the salaries, the electricity, you name it. We have to pay that regardless of if we sell the room or not. That is just the way that we have set up our business. And if we sell every single hotel room, we will pay for our fixed costs. But when they sit empty, we still have to pay that. Now, there's a variable cost of $50 per night. So the variable cost is probably the front desk, the housekeeping, any of the materials, supplies, laundered items, stuff like that. So then the question would be, what is the minimum price we should charge for the room based only on the financial results of this sale? So this is not considering that when they're there, they might go for dinner, or when they're there, they're going to pay for parking or anything else. This is just talking about just this room. Now, these are your four different options. Would you charge anything above 0, 50, 100, or 150? Now, if you were to answer this question, most people would say right off the hop, well, I would charge 150, because anything above 150 means I cover my fixed cost and I cover my variable cost, and therefore I will be making some money. Now, the real answer is you can charge anything, you can take anything above $50. And why is that? So, like we said before, fixed cost means that we have to pay it regardless if the room sits empty or not. So we are always going to lose $100 if a room sits empty. The variable cost is $50. So as long as we cover our variable cost plus a little bit more, right? So even if it's $1, so we sell this room for $51, then the hotel will lose, or they'll have $100 in fixed plus $50 in the variable costs minus $51 of revenue brought in, which means they still lose $99. But losing $99 is better than losing $100. And then, of course, the other, hey, they're in our building. They're going to pay for some other things, hopefully. They're going to pay for ski rentals, or they're going to buy a hiking pass, or whatever it might be, eat in our restaurants. But if we're able to cover the variable and put some money, and in this case only $1, towards the fixed cost, we're in a better situation. So as a result of selling the room for $51, you lose $99 rather than $100. And any amount above variable cost will contribute to help pay that fixed cost. So another question is, can we sell below total cost? So there's a couple things that we need to know. We need to know both fixed and variable costs. Now, fixed should be easy. It should be kind of set. Variable obviously fluctuates based on the type of business that you have. But if variable costs are covered and a contribution towards fixed costs is made, then selling below total cost can be considered. So a catering company that rents its facilities. So their annual fixed cost is that they have to pay $400 per day, regardless if it's being used or not. They've also determined that their variable cost is about 60% of total sales. The catering job for 60 people, they would make $10 each off each person. So they're going to make $600 off this. So right off the hop, if I'm thinking, okay, I'm accepting a job for $600, I know that it's going to cost me $400 just to be open. And then on top of this, I'm going to have to pay 60% of the sales that I bring in for staffing or product or whatever it might be. You already have an idea in your mind that this is not going to profit you a lot of money. But let's take a look. Let's work it out. So what you do is you figure out the revenue. So 60 people times $10 each is $600. You take away your variable cost, which is 60% of 600, so leaving you with $360. So the contribution of this job is 240. So we keep 240, 40%. Then we subtract our fixed costs daily, which are going to happen regardless of 400. We have an operating loss of $160. Should we not take this job because of the potential loss that we face? Yes or no? So this is where you as an owner or a manager might say, this is not a great job to take. This is not a great rental agreement. This is not a good thing that we should do. But what is the alternative? Are we just going to sit empty? Is my staff not going to have hours? Is there no one going to come in and potentially give great reviews of the place? What is, like, how do I really measure this if it's a good idea or not? So we look at this and say, hey, we're losing $160. But by losing $160, which means that we will have offset $240 worth of the $400 that we have to pay regardless. Okay? So it's like someone owing you $400 and you don't get all $400, but you get $240 of it. It's better than zero. So here, yes, we are actually losing a little bit of money, but we are not losing money or as much money if we were just to close our doors, send everyone home, no one's working, no food to order, no nothing. We would have lost $400 on in the day versus now we're only losing $160. So there are scenarios where it makes sense to actually know you're losing money, but you're still going to take the job. So this happens too. So someone books for 60 people and a lot of them can't show up. So now there's just 35 people that show up 24 hours before. Now, when we talked about in convention event services, if you're in my class or any other ones, we would have talked about ensuring you have a contract and making sure that there was a minimum number of people guaranteed. Let's assume that we didn't take those steps. So 35 people and they're still only paying $10 each. The revenue is $350. $350 at 60% of the variable cost is $210. Therefore, our contribution is now only $140. Fixed cost is $400. Contribution of $140 we subtract, which leaves us with $260 net loss. Now, that being said, it's still better than our $400 that we would have lost regardless. So we would lose $260 but still pay off $140 towards those fixed expenses. And then you have to ask yourself, at what point do you not take this job, right? If you made $1, so instead of paying $400 at the end of the day, you only had to pay $399 towards fixed costs, would it then be worth it? And there are other things to think about, because yes, finance is numbers and it's easy to make measurements and decisions, but at the same time, there's a human factor to everything as well, and a reputation factor as well. So if you take a discounted job or you accept a discounted job like that, you have to understand how this could affect your reputation. So if you are consistently offering lower tiered, lower priced jobs, you will then have the perception and the reputation that people will come to you. It is only worth that discounted price. And that's an issue with a lot of our hospitality and tourism, where they give a smaller price, and then therefore that's the bar. So anything over that they feel is overpriced and they don't want to pay for it. So guests will be less likely to pay the full rate if they believe they can get the discount. Ultimately, it becomes harder and harder for the profit to achieve an average daily rate that results in an overall profit. So it should only be used in moderation. You should not be using it for friends and family. You should not be giving this rate out as often as you should. You want to set a high rate as much as possible, because often people are willing to pay whatever it takes to get into a place. And if they want a discounted rate, your place might not be worth it. So it might be worth it for your reputation alone to not accept that job, because what it doesn't mean not for what it means for this particular day and how much money you're making, but what trend it sets or what image it sets going into the future. I hope that makes sense. And then it comes to our next big question. So the very first part that we just spoke about here, these first slides, this is more so about just, day to day. Should I take this? Should I not? How do I set my revenue or set my pricing a little bit? This stuff might be as a multiple choice question, but it won't be as any of your in-class activities or on the test as a major question. This one, should we close during the off season, will, just so you know. So here's a couple little different stats for you. So we are, typically we close during the off season, or we can close during the off season. Sales and revenue costs were collected for a year and for 10 months. And the operation was generating money in the 10 months and was losing money in the last 2 months. Variable costs were 20% of sales revenue. Total fixed costs were $252,000, which works out to about $21,000 per month. So here they're giving you just a little bit of information saying, in 10 months, we make a net income of $90,000. In 2 months, we lose $30,000. And overall, we are making $60,000. Now, just by looking at this, like glancing at this, you'd say, well, if we close for the 2 months, wouldn't we just keep our 90 and not lose the 30? And why wouldn't we just close for those 2 months? It doesn't exactly work like that, because fixed costs will always remain there. You always have to pay fixed costs. Some of this variable cost you might have to pay depending if it's salaries, and you still want your employees, because most employees, if you say you have 2 months off, they might not come back. They still need to be paid. So you have to do a little bit more digging and to understand if this is a good deal or not. So normally we would choose to close since there is a $30,000 loss during the 2-month period. So this is what happens to our net income if we choose to close for the 2 months. We have $90,000 less the fixed cost for 2 months, so that's $42,000. Net income if closed for 2 months is $48,000. So we were paying $21,000 a month towards our fixed cost. And if we come back up here, our fixed cost $42,000. We still have to pay that. We have $15,000 of sales revenue. which after paying for variable still put $12,000 towards that fixed cost. It was paying a bit of it. So automatically when you first look at this, say, hey, close to 2 months, we'll keep 90, and it's not true. What would happen is that we would only have $48,000. So by looking at this, do you want $60,000 and remain open for 12 months, or do you want $48,000 and only stay open for 10? Now, depending on the ownership, $12,000 and having 2 months of vacation, that might be worth it to some people. It all depends where your priorities lie. There are other influencing factors that need to be considered as well. So is there an additional close down and startup costs? So this often happens where when you close down, you might have a week or two of labor. Same thing with your startup and you're not bringing in any revenue during that time. So when you do, it might not look as nearly as attractive as we just showed right here, where we only lose $12,000. We might have an additional week or two of labor. So we might be down to $45,000. There's also employee job security. If you have good employees, you want to keep them. A 10-month contract is not really that enticing because we still have to live. And it's hard to work for 10 months and save enough money for 2 months of not working. And often what happens is that they'll take other jobs, but those other jobs might be year-round and they won't come back. So what typically happens in an industry like this is that you are consistently looking for new staff, and you are spending lots of time training because your new staff or your staff that's already trained didn't stay. So there's a cost to that. It's not as easy to factor or not as easy to determine, but there is a cost. So here's another example of which restaurant should we buy. So here's a couple different ideas. So it's the same clientele and size, and it's the same asking price. They all make $1 million in sales revenue, and they all make $100,000. So option A has a variable cost of 50%. Option B is a variable cost of 30%. So, and assuming a 10% increase in sales revenue, let's take a look at how these two different options would work. Okay, so we have restaurant A and restaurant B. They both make $1 million. Their variable costs are 50% of $500,000, so that's 50% of 1 million, or 30% of 100,000. Fixed cost is 40% at 400,000 versus 60% at 600,000. Each of these are totaling $900,000 of cost split between the variable and fixed. So they have a very similar kind of first year. So we're looking at they're making $100,000, they sell $1 million. Now the only big difference is one may have invested into different technologies and a different equipment, which gives them a higher fixed cost but lowers their variable, which means that they always have to pay this. So when things are good and you make more money, your variable costs will stay lower. But when things are bad and you make less money, your fixed costs don't go down with it. So variable is good when you're making money, but variable can be bad when you're losing it. So we'll take a look at a 10% increase in sales, and let's see what happened to their net income. So now we're making $1,100,000. And if we take a look here, 50% of that, that's their variable cost, $550. Fixed costs stay the same. Their total costs are $950, and they make $150,000. So a 10% increase in sales gives them an extra $50,000, which is fantastic. But we look at a restaurant B, because their variable costs are lower, they end up only paying $330,000. Fixed costs still remain the same, and then therefore their total costs are $930,000. So there's a $20,000 difference between these two, and this is just all how they have set up their operation. This one has a greater investment into the company, but therefore they have to pay more fixed costs per year. This one has a greater reliance on maybe more employees, so that's your variable cost, maybe more equipment, or more staffing and materials versus this one. But as you can see here, if you look at it, you can see that your total costs represent only 84.5, and this one's 86.4. So as sales go up, places with variable costs do better. As sales go down, well, let's take a look. So let's say that our same restaurant, but it had a 10% decrease in sales. So our $900,000 for each. Our variable cost is $450 and $270. Fixed costs were still always $400 and $600. Now our total cost for restaurant A is $850,000. Restaurant B is $870,000. Here, restaurant A with a declining sales revenue is making more money than restaurant B. So it's a very difficult thing to understand because this has a bunch of moving parts. You have to understand that there's a higher risk involved with restaurant B, but a greater return on income. So as long as you are doing better and you're increasing sales, which the majority of restaurants and businesses in the world, that's their intentions, that every year they're going to make a little bit more money. This one here is much better. Now, if you're a little bit more risk adverse, if you can't weather a storm where it's going to have lowered sales, restaurant A would be a better choice for investment. Again, it would be up to each individual investor to come up with an idea and say, I think I want to go with A or B. I think I would go with B because I think that's just a better call. I want to make more money as time goes on and I'm willing to commit to my business. But someone who maybe is in a different place in their life, if they're, let's say they're 60 and they only want to do this for a few years and they want to go into retirement soon, they might choose restaurant A. So that is cost management. We look at just a couple different things as far as how do we want to close a business during the off season and what are some of the impacts? Do we want to buy a certain business and what do I need to know? The difference between a fixed cost and a variable cost, as well as what is a minimum pricing and what am I able to sell something for, which still makes sense. And it might be a little bit different than what you thought. This will bring you to doing the in-class assignment. So sorry, this is the actual, I haven't developed an in-class assignment just quite yet for you, but this is the actual assignment in package number 3. So what happens here is that they tell you all kinds of information. So they tell you that the owner at Kempenfelt Bay Resort, they're contemplating closing the resort in the 4th quarter to eliminate the loss and take a 3-month vacation. So now you already know the human component of this, which means the owners actually just want to take a vacation, but they want to ask you for your advice. Is it worth it for them? So a few things that you need to understand. Wages and salaries, $3,500 of that is a fixed cost of key personnel who would stay on the payroll. General management, accountant, HR, something like that. Supply expense cost varies directly with the sales revenue. None of the supply cost is fixed. So when I go down here, if the 4th is closed, none of the supply cost is fixed, which means if you're not open, it's $0. So this is saying if the 4th is closed, you're going to put these numbers in here. So something like sales revenue, it's going to be 0 because we know it's closed. Our cost of sales is going to be 0 because it's tied directly to revenue. And therefore, our gross margin will be 0. Those 3 are freebies. Advertising, $300 of advertising cost is fixed. The rest of the cost is variable. So advertising, where in the 4th quarter you were paying $600, now we're paying $300. Now this would probably be, maintaining your website or maintaining some sort of social media ads. Utility expense, even if it's closed for 3 months, the resort will still require some heating. This is $200 a month. Now just be careful here. There's a couple times I'll ask you for cost for a quarter and cost for a month. There are 4 quarters, which are business periods in a year. Each quarter is representative of 3 months. So if the heating is an estimated cost of $200 a month, your utility expense would be $600. Some light maintenance required during the closed period with an estimated cost of $200 for the quarter. So I'll put 200 in there. And I don't want to go through all of them and do it for you, but there's a few more that you'll go through. Rent as an example, there's an annual expense of $20,000 that must always be paid. So that $5,000 will always be there. So you have to go through and fill out all of this information. In this column here, what you will do is find out what are the new totals. So the new totals will be the 1st quarter, the 2nd, the 3rd, plus the new 4th, which is if it's closed. So you'll go through and add all those up. I messed that up. There we go. And 1, 2, 3. So here we're already seeing we were making a gross margin of 190,000 and we were making 312,800 in sales revenue. If we close automatically, our initial change is going to be, it'll be 272,000 instead of 312. And we're taking home from this, or our gross margin, gross profit, is 171,000. Okay? So go through all of this, determine all of the new deductions and costs, and tell me what your total operating expenses will be for the entire place if it's closed, as well as the earnings before income tax, which will be this amount here. So right now they're making $18,750. You tell me, or you will figure this out and tell the owners what their new amount is. Now again, this human component, they want to take a 3-month vacation. They're the owners of a resort. They want to get away for a while. So what would your advice be after an analysis? We're pretty certain that we're going to make less money. So looking at this, come up with a good idea of what you think is worth it for them, saying, hey, if we do close, we would have lost $10,000 in that quarter. You're still going to lose $15,000, so $5,000 extra. Would it be worthwhile for you or not? And they might say, yes, that's I'd rather take a 3-month vacation and have 5,000 less than have to work three more months just to lose $10,000. So you'll go through that. You'll answer the questions. As you've probably already looked, there's week 10, week 11, and week 12, which is labor and payroll. I love this particular one. I think it's a lot of fun. Please go through these, answer, and submit before the end of next week, which will be, so next week's class, and then that'll be April 18th, which is when this is due. And then for you, you'll either have your final test on April 19th or the 21st, depending on what class you're in. Other than that, hope you're all doing well. Happy Easter. And we will talk soon.